Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. The first print here off Lisa's great data check is up 595 on the Dow. What a perfect moment to speak to Mr. Eisman. With Neuberger Berman, acclaimed in a movie of a few years ago, look for the new Eisman Hollywood property. I think it's a Memorial Day, Paul. You know, Memorial Day is a good opening.
Sure,
that's
what I hear.
It's very good. Look for Bear Squeeze. You're going to see that Memorial Day 2025. Steve, is this just one big short cover? We got the wall of money out there. Lawrence McDonald has been brilliant on this. With the action yesterday, is it an indirect short cover going on?
That's too sophisticated for me. I mean, I find the whole incredible amount of energy that people spend on the Fed day more amusing than informative. You know, think about it for a second. How much ink was spilled about whether the Fed would lower 25 or 50? All right, so they lowered 50, and then what happened? The market had no reaction. Just went up and down. Nobody knew what to do. And today the market's up huge, but rates are higher. So, you know, you put it all together. I try not to spend too much time trying to figure it out. All I care about is the general direction of the Fed is lower. How much lower, I don't particularly care. I don't think that's particularly important. The more important question is, how's the economy? The economy has slowed, but the data seems to indicate that the economy is fine, and that's all that really matters.
So what, other than the, or I guess in the context of the economy, what are the drivers for kind of whether you're bullish or bearish? What are some of the big variables that you focus on?
I've gotten thematic, more thematic in the last bunch of years, and I think that there are two great equity themes of our time, and we try and focus our portfolios as much as reasonable on those themes, and those are AI/tech and infrastructure. And I think those themes will last for years. There'll be variations. You know, on the infrastructure side, politics do matter, but the overall theme will continue.
Paul, let me interrupt with a data check here as the market surged. Dow up 566 points. On a percentage basis, the market lifts here at 933, greater than futures. NASDAQ up 2.3%. As Paul predicted, the VIX comes in 16.40.
On the AI trade, Steve, how do you suggest people play it? I think the first name people kind of jumped on was NVIDIA, for good reason, because they put up that big revenue print a couple of years ago. How else are you trying to play this?
So, I mean, the way we play it is the way most people are playing it. NVIDIA, some other chip companies, the very large companies with massive databases. You know, then the question becomes, you know, what apps and who's going to create them are going to work. And I think that is so early right now that it's really not worth talking about. You know, just as an example, the part of the business of Accenture that is doing extremely well is not the consulting side, which would do when companies are spending a lot of money on AI. It's the outsourcing side. And the reason why the outsourcing side is doing well is that most S&P companies do not have their data sufficiently in one place, structured appropriately to really even do anything with respect to AI. So it's very, very early in the AI story. The one longer-term theme that we've been thinking about, although it's so long-term, I don't know quite what to do with it yet, is I think there's a good argument to be made that we have seen hardware re-rate up and software somewhat de-rate. And I think it's possible that AI could cause that to continue, because it's possible that the cost of creating software because of AI is going to plummet. And if that's the case, some of the iconic software companies out there may not have moats around their businesses that are quite as high as they used to be.
Within the skill set that you've earned and at Neuberger Berman, do you people believe the CapEx expenditure of technology is being done intelligently and efficiently, or is there wasted money being squandered away on AI?
I mean, I'm sure both. It's we won't know the answer to that question for years. So I don't think it's worth trying to figure that out at this point.
So how else do you think? I mean, a lot of folks are concerned about this Mag 7, this concentration risk, just as a market concern. Do you have a market structure concern that so much of this market is weighted towards these Mag 7, or is that beyond kind of how
Well,
you
I think one interesting aspect of that, and I'll come to that, is that many active managers, probably more on the institutional side, underperform because their risk parameters don't allow them to overweight the Mag 7 because the Mag 7 is so big. And it's probably going to continue. I don't think we will really see a broadening out until we see apps come out so that some of the more middle companies can do that. But we're a ways away from that.
Do you have a favorite Mag 7? Is there one where
I don't want to talk about individual stocks. I'm just not going to do that.
All right.
My firm gets me into trouble.
The firm gets you into trouble. You don't get yourself into trouble.
Never.
Okay, I got it. On the infrastructure.
Nobody's listening.
On the infrastructure theme.
Yes.
Do I go out there and just buy like Cummins engines and?
Well, let me talk about that because politics are important.
Okay.
So I think that there are 4 mega infrastructure themes, and then there's a 5th. The 4 are onshoring. The second is, improvement of the grid.
Yep.
The third is everything having to do with actually building the data centers, and that there's overlap there with the grid. And then there's greenification, and then there's all the bills that Biden passed to shove money into all 4 boxes. Where the politics can become important is, I'll do 2 extreme cases. If Trump sweeps, greenifications are going to get de-emphasized. And if Harris sweeps, greenification will get re-emphasized. So that's important. So the politics here are important.
Steve Eisman with us, and we will continue here. Let me do a data check here with markets on the move. SPX Dow at records. Dow up 540 points to the solid 42,000 print on the Dow. 5,700 SPX up 86 points. NASDAQ 100 up 2.2% with Steve Eisman.
Steve, how concerned are you, if at all?
We're not on right now.
What's
we
that?
On?
We're on, baby.
We're on.
We're on.
Oh, it's for radio. It's hard to tell.
Yeah, with the red light. We make it easy. The red light. When the red light's
red light.
on, yes, that's for me.
I just learned something.
Exactly. All right, valuation. How concerned are you, if at all, about this market broadly?
I think I learned this lesson in the dot-com bust. So, when dot-com was rocking and rolling, everybody was yelling and screaming about valuation. But that didn't matter until there was a recession, and it turned out that a lot of these companies had actually fundamental problems. So generally speaking, I'm not going to invest in a company that sells at 1,000 PE. That's just not what I do. But we'll invest in some high PE stocks. I just don't feel like it's as long as the economy is fine. It's more of an academic exercise than anything else.
So the economy, from what we're hearing from you, the economy really is underpinning almost everything the foundation, I guess, of how you view investments.
Correct.
Okay. How about on the fixed income side? What do we do there? I can sit in a 2-year treasury. I used to get 5%. I'm still getting 3.6%. That's not bad for, no risk. Or do I go out there and take some credit risk, do you think?
Look, we do some corporate bond investing, but mostly what we do is equities.
Okay.
I don't have a strong view on fixed income right now, one way or the other. I really don't.
Do you have alternatives in your portfolio?
I don't have alternatives either.
So
I'm just a stock jockey.
Stock jockey.
Stock
the
jockey.
old-fashioned stock
and
jockey.
I always have been.
Okay, we got to talk banks here and financial with Steve Eisman. Here's a quote So yeah, I met with this retail banker yesterday, and I'm supposed to be getting him to invest in our fund, but instead I start grilling him about our overdraft penalties and how his bank lets a customer write 10, 12 checks before they tell him they're overdrawn, and this creep is making billions off of screwing over people this way. Script of
That sounds like a much younger version of me.
Yeah, it does. It's from the script of
a very angry young man.
A very angry young man from 2015. Can you buy New York big bank? Can you buy the future of Bank of America? You know, not individual stocks, but can you buy the big bank success of the future?
So let's talk about what the positives are. The positives are that the regulators did a very, very good job post Dodd-Frank, led by Vice Chair Daniel Tarullo, truly one of the unsung heroes of the financial system. The leverage in the banks is cut by more than half. Even within that leverage, they have been de-risked. So the financial system of the United States, as far as I'm concerned, is very, very safe, and I don't lose any sleep about it. And by the way, I sleep very well.
Right.
But do I think there's a great story to invest in some of the very large banks?
Right.
Not really. I just don't think there's a story there one way or the other.
Too important. I got to get this in. Lex in the FT today blistering about private equity and the ability not to cash out. Do you see potential problems within the illiquidity of private equity?
You know, you could spin any bad tale you want. There's just not enough data on what's in private equity to really know one way or the other.
You can't make that guess.
I can't make that judgment.
See that? You know, his lawyers love him.
It's not his first go-round. It's not his first rodeo.
Won't do individual stocks.
Oh, my lawyers love me. You know, one time, quick story, in the 90s, I was at Oppenheimer, and Oppenheimer got sued over something that I had written, and there was, it was discovery, and the lawyers called me and said, send us everything you have on this company that you wrote about, and I sent it to them, which was only the reports that I had written, and the lawyer called me and said, what about your notes? And I said, I don't have notes. I don't take notes. He goes, I love you.
Steve Eisman, thank you so much. We love you too. Greatly appreciate it. Mr. Eisman is with Neuberger Berman. Some perspective there, given most interesting times. Julian Emanuel joins us right now. Can you send thanks to Ed Hyman, and tell him thank you for appearing generously 10, 11, 12 days ago and then coming in with your redo call? He cast aspersion on you. What did you say to Ed Hyman to get him to switch a view from recession difficulty into the soft landing we're celebrating this morning?
Well, I think if you go back and think about it, Tom, what it does is, our business, first of all, forecasting things is difficult, whether you're an economist or a strategist.
Absolutely.
But it's part of the process. Again, Keynes is famous for the statement, when the facts change, I change. What do you do, sir? We went through that same thing ourselves at mid-year in terms of taking our price target up to 6,000. Essentially recognizing that this environment is totally different than anything any of us have ever seen.
And with immense respect to C.J. Lawrence and what Ed Hyman invented years ago, is the distinction pandemic fiscal stimuli, or is it a new productivity we don't understand?
Well, and the kicker is that it could well be the new productivity we don't understand. And clearly, you wouldn't have seen the announcement of this massive deal for building AI, power plant type build out that we've seen in the last couple of days, if there were not the belief, and we share that belief, that AI is absolutely going to underpin productivity in the long run here.
What did you make yesterday of our Federal Reserve and kind of what their messaging was? What did you take away from that?
Well, it really was an example of, again, getting the dual mandate back squarely in focus, but also reinforcing the message, we're cutting because we can, not because we have to. And this whole idea that, they know something that we don't with regard to economic weakness. completely discredit that. But yet at the same time, it's also an implicit message that if the data does weaken, and particularly if we have the kind of election volatility that we had, say, in the hanging Chad year of 2000, where stocks were similarly expensive, the economy was starting to slow, and then all of a sudden you couldn't figure out who the president was, and that soured the mood and soured asset markets. The Fed is prepared to act. The Fed did not act in 2000, and that's part of why you got a recession in early 01.
So given what we've heard from the Fed yesterday, given what we know about, I guess, earnings, is it full speed ahead on risk assets? And if so, where do you see the opportunities?
So we do continue to be very positive into year end, and so far 25 looks good to us as well. Part of this narrative again is the Fed's behind us. We have earnings that will once again, when the reports start in a couple of weeks, confirm the fact that second quarter was not an anomaly. That yes, the other 493 stocks in the S&P 500 are growing their earnings, and that combination, along with the statistic that we quote and we really like, 6 out of 6 presidential election years where you were up double digits on Labor Day, every single one of them finished higher by year end.
What does the eye do to go to, Ed was in, and of course I start with trucking statistics because that's what he's doing. But what is the dynamics of corporate and business investment given the madness of the last 24 hours? Well, it's got to be plus.
It is. And again, we've been doing this a while, and we try to temper, it's Curb Your Enthusiasm, the legendary comedy show, because part of what you don't ever really want to do emotionally, and the last 24 hours is a perfect example of this, because the initial reaction was disappointment to way the market traded, and then all of a sudden this morning we've reassessed, and it's full steam ahead. We want to be tempered. But the fact is that we are in one of those unique situations where, because the economy looks like it's going to soft land, Ed having changed his forecast, you are in one of these win-win scenarios where companies are likely going to be more incentivized to increase CapEx, to take on M&A, regardless of the fact that valuations
Paul,
are high.
to take on new technology. I think it's understated.
How about old technology? I mean, here in the 2-year Treasury, we've gone from 5% yield down to 3.60. During that period of time, stuff like utilities and REITs have done well. Do they have more to go, or should I take some profits there?
So from our point of view, we've trusted in what we call the Fed rate cut playbook. And basically what it says is that a lot of the move on the long end of yields is done. Frankly, you've come in 100 basis points on the 10-year yield. If you're not having a recession, and we don't think you're having a recession, and the best of inflation is just recently passed, not to say that inflation won't continue lower, that to us means the yield story is likely higher, and that's where you want to sort of trim your holdings on places like REITs and utilities.
Single point SPX 12 months out.
Well,
come on.
I can't do that until we put out the year ahead, but frankly, we do think, particularly if you think about past valuation paradigms, we're expensive at 24 times, but we're nowhere near the 28 to 30 times we've seen in prior peaks, and the Fed is with us, and productivity is with us.
Julian Emanuel, thank you so much for that. I'm in Evercore ISI this morning. Let's talk to a bond guy.
Sure.
This is great. What an equity response we see here. Joining us now, Jim Caron. He's at Morgan Stanley for an extended period. He'll join us across this half hour. So Jason Furman's out yesterday, and he's got his offspring, a teenager, emailing dad in the middle of the Fed meeting saying, "You were wrong. I was wrong. I didn't say what my opinion was because nobody cares. Full disclosure, I was looking for 25. I was wrong. You were wrong. Why were we wrong?
I think we were thinking too logically about it. And by the way, Jason Furman's offspring's response was probably what my offspring would love to say to me as often as possible. So look, I mean, 50 basis points is absolutely a justifiable number. It was a close call. I think why we were wrong is that there was a component of Powell wanted to probably cut interest rates in July. And I think if you look at the dot plot and you look at the makeup of this decision, I think he kind of strong-armed the committee. And he said, look, we're going 50. We didn't do July. It was a mistake. And I need you guys to get behind me on this one. And I think that's why it was such a close call, and I think it was a judgment call. But I think there was a bit of strong arming that came through there. So that's hard. You know, that can break either way.
We had a dissenting vote there, and that's unusual. What does that tell you? What does that telegraph?
You know, it's been like 19 years since we've had a dissent on something like this. You know, during like a rate cut. Look, I mean, it tells me that, again, I'm going to go back to the dot plot. If you look at the dot plot for 2024, there's a lot of cohesiveness. Okay, we've got to cut interest rates. You know, we've got to get on the move here. When you start to go out to 2025 and out to 2026, there's a huge amount of dispersion of opinions across the whole thing. So I don't think this is just a done deal where the Fed, okay, that's it, we don't have to worry about it anymore. They're going to cut 250 basis points. The market's got that price. Let's all just sit back and relax, although that's what the markets are doing today. But you know, the question for me, and the thing that gets me the most on this whole number is the unemployment rate component, right? Everything is hinged upon a number that has been so terrible over the last couple of years, really since COVID. There's not a lot of certainty in the number, in the jobs reports. They're heavily revised, yet we're basing all of this monetary policy on a 4.4%, right, which is the Fed's unemployment rate target. I don't know. I mean, like, look, if the economy's really slowing, I would imagine that the unemployment rate goes up.
And, you know, I'm not going to give my opinion here, folks, but I am going to say what I'm going to observe around what Jim Caron just said is the 3-month moving average of non-farm payrolls. David Kelly over at JP Morgan, that's another bank. I don't know if you're familiar with them. David Kelly says, look, you're going to get a vector to a 3-month moving average that could be a negative statistic, and that would be the shock Jim's talking about. Okay, physics envy here, Bowden guy. I took from 0.25 out to 5.50. Bob Sinch taught me how to do this. You strap a Fibonacci to get a central tendency. 2 7/8 would be the roughly central, in the middle and neutral. We have 10, 25 measured rate cuts to get to normality as well. The reason he was bold and strong-armed him, because he knows he's got massive room to move to quote-unquote normal.
Right. So, look, we can think of this, you know, the Fed's decision is almost like talk about physics, a three-dimensional problem, right? The first dimension is where is that neutral rate? Now, you just highlighted it, 2.875%. Let's call it 3%. Okay, fine. Let's just make that 3%. The second question is how quickly do you want to get there? And the third dimension of this whole thing is the unemployment component, right? If the unemployment rate rises fast, then they're going to move fast, right? So what my view is that if we are in an inflationary environment, and I still believe that we are in one, inflation's stable for now, then that means that the Fed does not have a free shot at just cutting interest rates as aggressively without inflation picking up. And that could slow their rate of hikes.
Paul, can we do spherical geometry now?
Let's do it.
Okay, let's do it for George Struick of MIT years ago. But the bottom line is the elasticities of the X, Y, and Z axis there are different. I agree with you that the mother of all elasticities pre or post-election is the labor economy and the unemployment rate.
Right. Yeah. And so my suspicion here, again, this is a suspicion, is that one of the things that triggered the Fed to move as aggressively as they did is that they may think that the employment situation is worse than what the data is actually telling us, and that they do need to move quickly today. So this goes back to the thought that if they go 50, what are they telling the markets? Should we be nervous? I'm a little concerned here, and I want to be very clear about that. I want to admit that I think the unemployment rate is probably really higher than what is actually being forecasted in the data. And remember, this data gets revised all the time, And I think, as David Kelly was saying from that other bank, I think JP.
It's another bank. Where are they?
It's another
Park
bank.
Avenue.
You know, he may be correct about this, right? You know, you could get into a period of time.
Why do you think that data is maybe not as accurate?
So look, I mean, all of the statistics that have been coming through. Well, first of all, we had an 840,000 revision to payrolls, you know, lower than what we thought, right? So like the run rate is much lower. We got that last month. We have a significant amount of immigration, right? So we're still trying to calculate all of the people. Like the labor force grew. When the labor force grows, when the economy is really strong and the unemployment rate's 3.5%, that's great. When things start to slow down, a really large labor force can actually be a little bit of a deadweight drag on the economy, because what that means is that you have a lot of people looking for a job and less jobs available. That unemployment rate can go up quite a bit. So that reflexivity argument that Tom's making is actually extremely important. Like if the unemployment rate today was 5.2%, we'd be having a different discussion right now.
To go Merton or Taleb on you, the point here, folks, of all this blather, which only Jim Caron can do with his prodigious physics ability, is there's an assumed belief that we have a resilience, what in the physics world would be tensile strength, to withstand these shocks. Right. Baloney. We don't. Nobody listening, except for old farts, understands that a 5% unemployment rate changes the dialogue.
Yeah, absolutely. I mean, look, I mean, you know, this is where the markets really start to lose steam, and I think this is what the Fed is worried about the most. So what they're communicating is that they will be very aggressive in order to defend that 4.4% unemployment rate level. And that's what we have to watch, because it may be difficult for them to defend.
All right, Jim, you're sticking around. You're not going anywhere.
I still want to talk Jets-Patriots, by the way. It's the best game of the night. It's the best game of the whole season, by the way.
Wait. Alarian came in yesterday because he got tickets to the Jets. Is that why you're here today? You're going as well?
I'm a Patriots fan. So, no, I'm not going.
Just get ugly. Side, take a note. We got to get Jim Caron and Mohamed Alarian together.
Yes.
I just got an email from Boston. Enough of the Jets. Now, Sweeney won't talk about this because the future, Tom Brady's a UNC guy.
Exactly.
But, I mean, you got Jacoby and this guy from UNC. Is it a rebuilding year for the Patriots, or is it like, let's go?
No, I think it's a rebuilding year. Look, I mean, the Patriots have had some, has had a tough go of it. But this is why I'm excited about the Jets game, right? Because the Jets, it's always kind of random with the Jets, right? You just never know what you're going to get. Yeah. I know they're favored to win. They're favored to win by about 6. I think the total point score in the game is just under 40 points. So it's going to be a relatively low-scoring game. So it could be very interesting. 2 very evenly matched teams.
Yeah, but we didn't want to talk to you about this. I want to know who's doing better, Brady or Belichick? Brady's doing better?
Yeah, I think so.
I mean, you've had a whole generation of Patriots fans that have only known winning and winning Super Bowls. What's the mindset for the folks?
Depends how old that Patriots fan is. Because I have like maybe 20 years of really, really bad memories.
Right.
So, yeah, very true.
Let us continue here with Jim Caron and Morgan Stanley on where we are. Yesterday, a lot of smart people were talking the Jim Caron dialogue. They're watching spreads. Tell mere mortals now how odd your bond market is and what spreads will do given the Powell soft landing.
So this is positive for risky assets and credit spreads, just broadly speaking. Powell is basically saying that he is going to stand behind and support this market. If we look at default rates have been coming down. Specifically, Tom, default rates have been coming down even in the CCC space. So even in the part of the credit market that people are worried about the most, so the lower credit echelons, CCCs, those spreads have actually started to come in as well. Now, if that starts to happen, then what you're going to see is a decline in the overall yield for high yield, and it makes it a very positive setup for these assets. And let's not just talk about high yield. We can also talk about private credit, private assets, all of these other things, all are competing with each other for returns. So as these bond yields and these credit spreads start to come in, money is going to start to follow it. And I think this becomes positive, not just for bonds, but also for equities.
I mean, I'm looking at the INGO function on the Bloomberg terminal, a Bloomberg index browser. Boy, the best return has been in that U.S. corporate high yield market, up 7.5% year to date. I mean, that is really strong, particularly given the brutal 2022 the fixed income market dealt with. A little bit of thanks to November, December 23 came out okay, but this year looks pretty solid.
Yeah, so fortunately, I'm happy to say that we've been overweight high yield all year, so even counter to popular views at some points. So look, high yield has two things going for it. Number one, the majority of the high yield index is actually the higher quality, is actually double Bs, which means that high yield has a longer duration, so they have more interest rate sensitivity built into them. So as rates start to come down, high yield is also getting the benefit of the decline in interest rates in addition to the decline in default risks, particularly in the lower credit segments of that overall index, which are the triple Cs. So put those two things together, and high yield starts to look, very attractive, or it's looked very attractive. It's becoming, maybe a bit more pricey right now, but there's no reason to believe that you're not going to really get that coupon minus some of that default risk, and that's what the markets are betting on right now.
As a former investment banker, I pay attention to new issuance in the equity markets and in the bond market.
Yeah.
Boy, the bond market, issuers have been coming to market like crazy. Do you guys pick up the phone when they call you?
Look, absolutely. And talk about issuance and technicals and supply. One of the things that's been interesting about high yield is that the technicals are so positive that the net supply of high yield is negative.
Oh, okay.
Meaning that, so there's been gross issuance in the high yield market, but on net, there's been more things maturing and, versus what's been being issued. So on net, the supply is actually negative. So not only do you have some positive fundamentals, support from Powell, but you also have supply technicals that have been very strong. And like you said, you're putting up some pretty good numbers this year.
Wow. So, all right, what do we do here? I guess, think about total risk here. Where do I go? Where is it better? Equities, fixed income, alternative investments? Where do you guys see the best opportunities? And I guess what is a solidly declining interest rate environment?
So let me say that we're also overweight equities at this point. We have more of a risk on tilt towards equities. Okay. The thing that we have to recognize here is that if you look at 2025 full year earnings for equities, it's around $280. Now the view there is that you would get a PE multiple decline. It would come into like 19 and a half, and that would suggest that maybe earnings come down as well, and you get a lower equity price. But what's starting to happen right now is that $280 earnings number for 2025 is becoming more believable. People are assigning a 20 or even a 21 PE multiple to that. So you're getting numbers that are getting up towards that 5,800, 5,900, and I know that's obviously what's going on today. All of that is getting pulled forward. That's my concern with equities right now, is that we're pulling forward all of that 2025 potential good news, and it's happening right now. So now, as we go forward, it's going to be about show me the data, show me the numbers as we move through the fourth quarter, as we move through the first quarter. And we're priced, I don't want to say to perfection, but pretty close to it.
But if we pulled forward bonds, price up, yield down, spreads at, odd levels to say it's the same thing in bonds. I'm sorry.
So you're absolutely right, and that's why we're underweight fixed income. We're underweight duration here, even though the Fed's cutting, and we expect because the markets have already priced this in. Right, we're already looking at a 10-year note that's around 3.75%, a 2-year that's about 3.6%. If the yield curve steepens, how much further can these bond yields go down? Even if the Fed goes to 3%, how much further can these bond yields go down?
Can we link our Ute? Let's do this now with James Caron. I went up to Orono, where they have a black bear, to see a total eclipse of the sun. It was a racket my father was in. And we had to stop at Bowdoin and stare at a 132-year-old observatory that was like the original thing. A student died in a rock climbing accident, and his father put up the money to rebuild that puppy at Bowdoin. Did you go into that observatory as a kid in physics?
Absolutely, it was a rite of passage. You had to go
Enjoy
there. Yes, no, it's such a historic thing. Absolutely, there's no question, and that eclipse was pretty interesting this time around.
Yeah, it was great. But the Bowdoin, explain to our audience what's it like to be a bratty 19-year-old in physics, and you got to sit there and put your eye up and say, oh, that's the moons of Jupiter. It gets you right back to the 1600s.
It's humbling. There's no question it's a humbling experience when you're surrounded by so many smart people and you realize that, as much as you want to, think of yourself, you realize that there's a bigger universe around you, and it gives you a lot of perspective. And I think that's the one thing that I really learned and took away from that.
We got to do UNL Arian at some point here. Patriots and Jets. Jim Caron, thank you so much with Morgan Stanley. Really informative there. if you look at somebody's resume on LinkedIn, you can say, well, this was easy. You drop by the Treasury and you do some John Taylor kind of John Snow International stuff, and then you go to the White House, and the worst coffee in the world. They serve coffee in styrofoam cups at the White House. Everybody goes out to Charbucks. Then you go over to the Federal Reserve and the Eccles Building, and you polish the table for the governors and the presidents. And then if you get lucky, you become chief U.S. economist for Bloomberg. And it starts somewhere. For Anna Wong, it started with one of my favorite people. He defined the study of gold with golden feathers a number of decades ago, Barry Eichengreen at Berkeley. What was it like in a lecture hall? How intimidating was it with Eichengreen?
It was actually a small seminar. And
so even worse.
He's not intimidating at all. He's just a sweet historian who's very into details and very meticulous in his empirical work.
In the empirical work, bring that forward to where you are, without question the most influential call in American economics this year. Forget about R. Starden Williams, that's old news. Birth debt and our misguess on the labor economy. How off the mark are we right now?
I think my estimate is that every month the non-farm payroll is overstating by an average of 91,000 per month. So if the 3-month average, moving average from June, July, and August is 116,000.
I mentioned that yesterday.
Yeah.
Go.
So basically, the true underlying pace is probably closer to 20,000.
Does that migrate to a negative statistic, as David Kelly at JP Morgan talks about?
Well, I think that would be very close to stall speed. So if the Fed's estimate of a break-even pace of job growth required to stabilize unemployment rate is about 200,000, and the economy is only producing 20,000 per month, then that would
Paul,
be...
that's jargon. Stall speed is what the Boston Red Sox are doing right now. Continue.
Why are they overcounting again? What's the miscalculation?
Right. So in an economic downturn, there's just a lot of firms going, bankrupt, filing Chapter 11, and we have seen as of mid-year a 31% rise in Chapter 11 filings. And at the same time, business formation is slowing. So as a result, the BLS estimate the job growth from net birth and death firms, right? Because they tend to get these data only a year later with the QCEW. Powell mentioned QCEW yesterday. I predict that the QCEW will be the next CPI supercore. Like now that Powell has mentioned that he's going to mentally adjust the non-farm payrolls according to QCEW, everybody will be paying attention to the next QCEW update, which would be for the second quarter. We estimate that the second quarter actually did see a sharp rise in bankruptcies and slowdown in job formation. That was the quarter when non-farm payroll in April was probably negative once you adjust for the adjustment.
Well, is the Fed now behind dealing with the labor market, do you think? And that may be one of the reasons why they went 50 basis points and not 25?
So Powell did not acknowledge that, okay. but I think they are now back on the curve. They used to be behind, now they're back.
When you look at let's bring this back to English, okay? Let's move away from you mentioned imperial work, Professor Eichengreen. Let's move it to English. Model what you just said over to the tip point mentally in the country of 4.x, 5.x unemployment rate. When do we emotionally get into stall speed on the unemployment rate?
That is the hardest question I've ever heard. Emotional stall speed.
Austin Goolsbee at Booth would have done that, Come on. I mean, when does the unemployment rate become politically painful in this nation? Anna Wong, is it 4.8%, 5.1%? Do I got to wait for a 6?
No, 4.8 is there already. In fact, now is already there. You talk to anyone on the street, they will tell you, not Wall Street, Main Street, they will tell you that it's hard to find a full-time job, they can only find part-time jobs, and they have to find a lot of part-time jobs in order to pay the bill. And in fact, this will show up in the household survey data if you drill into the details. So micro data shows that, in fact, the reason why prime age employment is at peak was because a lot of native of workers are working part-time, not full-time, as in a typical healthy labor market cycle.
What is the immigration policies or experience over the past 2 or 3 years with a lot of the migration coming in on the southern border? How does that affect, again, what's the analysis showing you? How's that affecting the labor market?
Yeah, so our estimate is that the unemployment rate of the new immigrants who came in since 2022 is about 11% right now. So I think it takes time to integrate them in the labor market, and during this transition period is when they could push up the unemployment rate. So it really depends on whether the labor market is healthy enough to quickly absorb them.
Okay, I got time for one more question because you didn't answer my last question. You went around it like a pro. The answer is, when does the unemployment rate become stressful for all, including the central bank? Are we near that, or does Anna Wong frame that out to June of next year, or even out farther? How close are we to labor stress?
So if you think that 4.8% is when people are obviously alarmed about the possibility of recession, then I think in the November payrolls, it's possible that you could see the unemployment rate rising to 4.5%.
To be clear, November, first week of November or first week of December?
November 1st.
Okay.
So that would be the October payrolls. Yeah. It's possible that judging by the unemployment flows, that could show 4.5%.
I rarely do this, Paul. I'm going to editorialize it. Powell sat these people down at the Fed, and he said, we got to get out front of the October payrolls, first week in November, right around the election, I might point out.
What's the greatest risk here to this economy right today? Is it the labor market?
It is both labor market and the election.
We didn't even go there. Thankfully.
Next time I drag Eichengreen in here, you got to show up.
I will definitely. He's my thesis advisor.
We got to get you both in here. He's been huge support for decades for me, and his paper at Jackson Hole last year on debt and deficit was outstanding. It was really got some splash. Anna Wong, it's August. I can't call you the Economist of the Year yet. It's too early. It's like the Oscars. I got to wait. But you're killing it, Anna Wong. For Bloomberg Economics, and with a team around her internationally extraordinary. We're doing great work How do you get a job at Bloomberg and work out of Barcelona? What is that about?
I don't know. Let me know if you figure it out.
Madrid. I mean, it's unreal. Anna Wong there on your labor economy into the end of the year. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.